Hey everyone, welcome back to the channel. We've got some major developments coming out right now about the 2026 tax filing season, and if you've already filed or you're getting ready to file, you're going to want to pay very close attention to this, because we're hearing that bigger tax refunds are officially hitting Americans' bank accounts, in some cases significantly bigger than last year, and at the exact same time, there are new warnings about possible IRS delays that could slow things down for some filers. As of today, February 13th, the headlines are lighting up with reports that the average tax refund is up 22% compared to last year, and that increase is translating to refunds approaching the $4,000 mark for many households. That's a noticeable jump from 2025, when the average refund sat around $3,350 according to the Internal Revenue Service, and a 22% boost adds roughly another $670 on top of that. For families already stretched thin by high living costs and record levels of debt, that extra money could not be coming at a more critical time. According to comments made on CNBC by Treasury Secretary Scott Bessent, the early data from this filing season shows that refunds are running substantially higher than they were at this same point last year. Now, it's important to understand that early season data can fluctuate because the IRS processes returns in waves. Historically, refunds tend to start smaller in late January and then increase sharply in mid to late February once returns that include credits like the Earned Income Tax Credit and the Additional Child Tax Credit begin to clear. Analysts caution that we won't have the full picture until more returns are processed, but even with that disclaimer, a 22% bump is turning heads nationwide. This surge in refunds is happening in a broader political and economic context that makes it even more significant. President Donald Trump has repeatedly stated that Americans would see historically large refunds following the passage of what he has called the One Big Beautiful Bill, legislation that introduced new tax provisions including the elimination of taxes on tips and new tax credits for certain Social Security recipients. Supporters argue that these changes are now showing up in refund amounts, while critics say the true impact will vary dramatically, depending on income level, filing status, and how much was withheld throughout the year. Either way, many taxpayers logging into their bank accounts are seeing larger than expected deposits, and that's fueling a wave of optimism at a time when household finances have been under serious strain. And let's talk about that strain for a moment, because the refund news doesn't exist in a vacuum. The Federal Reserve Bank of New York recently reported that credit card balances have climbed to an all-time high of $1.28 trillion when adjusted for inflation. That number is staggering. While balances are still technically below Great Recession peaks, the trajectory has economists concerned. Their latest survey of consumer expectations found that more households report being worse off financially than they were a year ago, and fewer believe their situation will improve over the next 12 months. Economists describe the current environment as a K-shaped economy, where higher-income households continue spending and investing, while lower and moderate-income families struggle with rising delinquencies on auto loans, mortgages, and credit cards. In that environment, a nearly $4,000 refund isn't just a nice bonus. For some families, it's a financial lifeline. The National Foundation for Credit Counseling has projected that financial stress levels could reach an all-time high in the first quarter of this year, with CEO Mike Croxon warning that many middle-income borrowers have essentially reached their financial limit. Polling suggests that roughly one-third of Americans plan to use their tax refunds primarily to pay down debt rather than spend on discretionary purchases. That tells you a lot about where the financial pressure points are right now. While bigger refunds sound like celebration-worthy news, for many households, the money will go straight toward reducing balances that have ballooned over the past 2 years. Now, there is some encouraging economic data mixed into all of this. Inflation, which has been one of the biggest drivers of household stress, showed signs of cooling in January. The Consumer Price Index rose 2.4% compared to a year earlier, slightly below expectations of 2.5%. That marks the lowest annual inflation rate since May of 2025, suggesting that price increases may once again be slowing. On a month-to-month basis, prices rose 0.2% from December. Energy prices and used vehicle prices have declined year over year, offering some relief. Grocery prices, however, are still up 2.1% annually, and food away from home is running about 4% higher than a year ago. Heather Long, chief economist at Navy Federal Credit Union, described the latest inflation report as much-needed relief for middle-class and moderate-income families. When you combine cooling inflation with larger refunds, it paints a picture of at least short-term breathing room for many Americans. But before anyone gets too comfortable, there's another headline circulating that has people anxiously refreshing their refund tracking apps: delays. The familiar question, "Where's my refund?" is already trending as the IRS warns that several factors could slow processing this year. The Treasury Department released a memo pointing to the 2025 government shutdown and a significant tax filing backlog as major contributors to potential delays. Even though the IRS exempted approximately 23,000 of its 39,000 key filing season staff from furlough during the shutdown, the disruption created ripple effects that are still being felt. Multi-year funding from the Inflation Reduction Act of 2022 was used to keep certain operations running, but inventory that went untouched during the shutdown is now being carried into the 2026 filing season, putting additional strain on reduced staffing levels. The IRS workforce itself has shrunk dramatically. The agency reportedly started 2025 with about 102,000 employees and finished with roughly 74,000, a 27% reduction. Cuts impacted nearly every division, including direct file operations, enterprise case management, the Office of Civil Rights Compliance, the Independent Office of Appeals, small business and self-employed divisions, and even the Taxpayer Advocate Service. Fewer employees handling more returns is a recipe for slower processing times, especially when combined with new tax law changes that require system updates and additional verification procedures. There are also technical reasons your refund could be delayed that have nothing to do with staffing. Returns that include the Earned Income Tax Credit or the Additional Child Tax Credit are legally required to be held for additional review under federal law, which typically pushes refunds, including those credits, into late February or early March at the earliest. If your return has errors, incomplete information, discrepancies in reported income, identity theft flags, or issues involving credits like the Recovery Rebate Credit that can trigger manual review. Filing Form 8379 for injured spouse allocation can also slow things down. And even after the IRS issues the refund, your bank or credit union's processing times can affect when the money actually appears in your account. For those wondering how to check the status of their refund, the IRS Where's My Refund online tool remains the primary resource for tracking federal refunds. State refunds must be tracked through each individual state's Treasury or Taxation Department website. The IRS tool updates once daily, typically overnight, so checking multiple times a day won't speed anything up. So where does all of this leave us? On one hand, we have early data suggesting that refunds are averaging close to $4,000, a 22% increase that many Americans are welcoming with open arms. On the other hand, we have structural and administrative challenges at the IRS that could slow delivery for some taxpayers. Politically, the size of refunds has become a major talking point as midterm elections approach, with supporters of the One Big Beautiful Bill pointing to larger checks as proof that policy changes are working. Economists, meanwhile, continue to remind Americans that the size of your refund ultimately depends on how much you paid in throughout the year. A larger refund doesn't necessarily mean you paid less in taxes. It often means you overpaid more through withholding. Still, perception matters. When families see a larger direct deposit hit their account, especially at a time when credit card balances are at record highs and financial stress is widespread, it feels like tangible relief. Whether that relief translates into long-term stability or simply a temporary reset remains to be seen. What is clear is that this 2026 filing season is shaping up to be one of the most closely watched in years, not just because of refund size, but because of what it says about the broader economy. As always, I'll continue monitoring updates from the IRS, the Treasury Department, and economic analysts so you don't have to dig through dozens of reports yourself. If refund averages continue trending upward, or if new guidance comes out about processing delays, you'll hear it here first. For now, the headline story is this: bigger refunds are real. Many Americans could see amounts nearing $4,000, but patience may be required as the IRS works through staffing shortages and backlog issues. If you found this breakdown helpful, make sure to like the video, subscribe to stay updated on every major financial development this year, and I'll keep bringing you the latest as it happens.